Hello traders. Let's talk about the recent gold bull run. Did you truly capitalize on the gold bull run that kept printing new all-time highs? Or were you hesitating, wondering whether the next entry would be the one that traps you at the top? When you trade markets long enough, you learn that powerful trends create both excitement and doubt at the same time. Gold's surge to repeated record highs was not just a price move on a chart, it was a lesson in timing, patience, and emotional discipline. As a trader, you were not simply watching candles form. You were managing risk, interpreting macro data, reading geopolitical tension, and deciding whether you had enough evidence to participate without exposing yourself to a sudden reversal. Let's walk through this the way a trading mentor would guide you through it. When gold began pushing through prior historical resistance levels, the first thing you needed to ask yourself was not, how high can it go, but, what is the structure telling me? Strong trends leave footprints. You likely saw higher highs and higher lows forming consistently on the daily and weekly time frames. Instead of obsessing over indicators, your focus should have been on raw price action. Where were buyers stepping in? How deep were pullbacks before demand returned? Was momentum accelerating, or was price grinding upward in a controlled fashion? During this rally, gold often broke out, paused, and then continued. That pause is where professionals make decisions. Rather than chasing a large bullish candle into fresh highs, you want to wait for retracement. Fibonacci retracement levels, particularly the 38.2% and 50% zones, frequently aligned with prior breakout levels. When price pulled back into those areas and showed signs of rejection, such as long lower wicks or bullish engulfing formations, that was your cue that buyers were still in control. You were not buying because price was high, you were buying because the structure remained intact. Now consider the risk of entering at extremes. When markets go parabolic, they feel unstoppable. During parts of the gold rally, price accelerated rapidly over short periods. This is where many traders lose discipline. You might have felt the pressure of missing out, especially when financial media headlines amplified the move. However, parabolic expansions often precede corrective pullbacks. When price stretches too far above its recent consolidation zones without retracement, you must assume mean reversion risk increases. Waiting for price to rebalance before entering protects your capital and your confidence. At the same time, you cannot ignore the macro backdrop that fueled the rally. Gold thrives in environments of uncertainty, declining real yields, and persistent inflation concerns. As central banks navigated monetary policy decisions and inflation data remained a focal point, expectations around interest rate adjustments influenced gold's trajectory. When real yields weaken, gold becomes more attractive as a store of value. You should have been monitoring inflation reports, Federal Reserve commentary, and bond market behavior because those data points influence institutional positioning. Geopolitical developments added another layer. Heightened global tensions and ongoing conflicts increased safe haven demand. Political rhetoric also played a role. President Trump's sentiments around trade policy, economic direction, and global relationships contributed to volatility across asset classes. Markets respond not only to policy implementation but also to expectations and tone. When uncertainty around trade negotiations or geopolitical alliances intensified, gold benefited from risk-off flows. As a trader, you must pay attention to these narratives because they shape capital allocation decisions at the institutional level. Now let's broaden the lens. Gold did not rally in isolation. Silver moved alongside it, often with even sharper percentage swings. When you observed gold breaking higher and silver lagging temporarily, that divergence sometimes signaled opportunity. Silver's catch-up rallies provided additional confirmation of strength in the precious metals complex. Watching the gold-to-silver ratio helped you gauge relative momentum. When both metals advanced in tandem, the move carried broader conviction. Equity indices offered another important correlation. During certain phases of the gold rally, major U.S. indices like the S&P 500 and Nasdaq were also performing strongly, driven by corporate earnings resilience and liquidity conditions. In those moments, gold's rise was less about panic and more about diversification and inflation hedging. However, during periods when equities pulled back due to geopolitical headlines or macro uncertainty, gold often accelerated as investors rotated into defensive assets. You needed to observe whether gold was rising alongside equities or in opposition to them because that relationship reveals the underlying driver of the move. The US dollar deserves attention as well. Typically, gold exhibits an inverse relationship with the dollar. When the dollar weakens, gold often strengthens as it becomes cheaper for holders of other currencies. During portions of the bull run, dollar softness provided additional fuel for gold's ascent. However, correlations are not fixed. There were instances where both gold and the dollar rose simultaneously, driven by global uncertainty. Your job was not to rely on textbook correlations blindly but to observe real-time behavior. Once you entered a gold trade during this environment, the next challenge was staying in it. Many traders struggle more with holding winners than cutting losers. When price moves in your favor and you see unrealized profit increasing, the temptation to exit prematurely becomes strong. You may fear giving back gains. However, if the broader structure remains bullish and macro conditions have not shifted materially, exiting too early limits your upside. Instead of reacting emotionally to minor pullbacks, you want to anchor your decisions in structure. As long as price continues forming higher lows on the time frame that justified your entry, the trend remains valid. You can trail your stop beneath successive swing lows or beneath key retracement zones that align with Fibonacci levels. This approach allows you to protect profit while giving the market space to breathe. At the same time, you must recognize signs of exhaustion. If gold begins forming lower highs after an extended rally, that is not random noise. If strong bearish candles emerge near major resistance with high volume, pay attention. If macro data shifts in a way that strengthens real yields or significantly boosts the dollar, reassess your exposure. Exiting is not about predicting the exact top, it is about responding to evidence that the conditions supporting your trade are deteriorating. Let's also address the psychological aspect because you cannot separate trading performance from mindset. The gold rally was exciting. Watching price print new highs repeatedly creates a sense of momentum that feels almost contagious. Yet discipline means staying process-oriented. You are not trading headlines, you are trading structured plans. When you approach the market with a clear framework: trend identification, retracement entry, defined risk, and structured exit, you transform excitement into controlled execution. There is also an element of enjoyment in mastering a move like this. Trading is serious business, but it is also intellectually rewarding. When you correctly interpret price action, align it with macro context, observe correlated markets, and execute with precision, you experience the satisfaction of operating at a professional level. That is the fun side of trading, not reckless speculation, but calculated participation. As gold trends in your direction, continue monitoring key variables. Watch how price reacts at prior highs that may now act as support. Observe whether pullbacks are shallow and quickly bought, or deep and aggressive. Track macro releases such as inflation data, employment reports, and central bank statements. Pay attention to geopolitical headlines, especially those involving trade tensions or global conflicts. If political rhetoric intensifies uncertainty, gold may extend. If stability returns and growth expectations strengthen, momentum could fade. You should also keep an eye on bond yields. Rising yields can pressure gold if they reflect stronger growth expectations and tighter policy. Conversely, falling real yields tend to support continued upside. Equity market sentiment provides additional clues. If equities rally confidently while gold stalls, risk appetite may be returning broadly. If equities weaken sharply and gold accelerates, safe haven demand may still be dominant. Ultimately, making an effective entry during a gold bull run comes down to patience and context. You do not buy simply because price is rising. You buy because structure, retracement alignment, and macro drivers converge. You avoid entering at extremes by waiting for confirmation rather than reacting to fear of missing out. You manage risk in a way that allows you to survive volatility. You stay in the trade by trusting structure, and you exit when evidence clearly shifts. If you approach markets this way, you stop viewing a rally like gold's as a gamble and start seeing it as a structured opportunity. Trends will come and go. New highs will eventually be followed by corrections. What remains constant is your process. When you refine that process and apply it consistently, you position yourself not just to participate in the next bull run, but to do so with confidence and control. Let's interact further down the course. Thank you.